preparedness starts at home. And we're firm believers that if you can take care of yourselves, then you can help your neighbors. And we have developed contingency plans because if you can't, like you say, put on your oxygen mask before assisting others on the plane, it's the same thing at home in our communities. And we are proud to be prepared. And I think everyone should be. The store shelves will go empty pretty quickly. The average inventory at your local grocery store is something like 3 to 4 days.
Hi, I'm Kaiser Johnson with Liberty and Finance, letting you know that as brokers for Miles Franklin, we can help you secure your future with precious metals for personal delivery, vault storage, or your IRA, with some of the best prices in the industry and privacy, security, and personal service that no one else can match. Our number for all orders and questions is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance, and back with us today is the chicken from Doomberg. Doomberg, thank you so much for joining us today.
Elijah, it's great to be back, and I really enjoyed our first appearance, and looking forward to another fantastic one.
Definitely, and our viewers definitely very much appreciated you having on. It was a very popular interview on our channel, and the comments were very positive. So we were like, we have to have Doomberg back on here. Last time we talked about the European energy crisis. Your perspective, if we could get an update on what's happening over there.
Yeah, lots of things happening since we last talked, and we kind of feel like the crisis has moved down the value chain a little bit. So the prices in primary energy have come off the top a little bit. You can't sustain such prices indefinitely, and they've pulled back a little bit. But now the second and third order effects of trying to swallow that golf ball down the garden hose is being felt. And the Eurozone consumer price index printed at 10% last reading, which is pretty remarkable. Double-digit inflation in a Western fully developed economy like the European Union. But more worrisome is these producer price index prints, which are in the 30 to 40% across the various manufacturing heavy countries in the region. And there's only two possibilities from here. Those prices get passed on to consumers, or margins shrink radically for the producers if they can't push those prices on. And as predicted in our piece where we developed the phrase anti-logic, unfortunately, governments seem to be in a bit of denial and making all the wrong decisions. Germany in particular talking about, north of $100 billion worth of subsidies and bailouts for consumers and businesses alike, which of course does nothing to destroy the demand that needs to stop, and only accentuates the inflationary price pressures. And this just this week we saw a pretty remarkable story that instead of saving natural gas, German consumption of natural gas is actually up this week, and the governments are really ringing the alarm bells because, one of the things we've noticed is many of our friends in Europe have a very sort of laissez-faire attitude about the crisis. They either think it's been overblown or that somehow somebody else will solve the problem, and this is not good. So we shall see. We do believe that stagflation is on the menu for Europe, and we shall see how it goes from here.
No, you're mentioning how a lot of the people in Germany are not really reacting to the higher prices in energy. How long do you think this crisis will last? If this goes on for quite a while, it seems like they do have to make a big deal out of it a while down the road.
Well, at the highest level, they only have so many molecules, and as we've written in several pieces and discussed on various podcasts. When you don't have enough molecules, the next question becomes how best do you ration them? And if they're intent on, taking the rationing signals away from the market and just convincing everybody it's going to be okay, then you have the worst of both worlds, where you have insufficient molecules and a totally inefficient way to ration those molecules to the most efficient, highest value consumers of those molecules in the population. And what almost always happens, and what we're seeing now, is instead the most politically expedient in the short term get the limited molecules, and then you sort of exacerbate the crisis. And so unlike currency, BTUs can't be printed. And, since we've last talked, the Nord Stream pipelines have been sabotaged, which closes off potential benefits to a peace deal, which is rather unfortunate. We're seeing what we believe are probably signs of significant escalation in the war between Russia and Ukraine, as opposed to a move towards peace, which we've long said would be the one potential salvation for Europe ahead of the winter. If that's off the table, and all signs indicate that it certainly is, things could get ugly pretty quick. And of course, it all comes down to the weather. And so we are praying for warm weather for our friends in Europe. A cold snap would be a very difficult thing for them to handle. If we have an unusually cold winter, things could get ugly pretty quickly. And then, as we were discussing before we started recording, and I'm sure we'll get into this, it's not just Europe, of course. Europe is exporting these inflationary pressures to countries who can least afford to bear them. And that's the sort of third order effect that we're going to see. So I think the primary energy crunch in prices is over. There's only so many carriers of LNG they can bid for. But now the pushing of those prices down the value chain happens in weeks and months and quarters ahead. And the economic consequences of radically reduced economic activity are what we're going to see next. So we're going to see elevated prices, consumer prices in Europe, producer prices in Europe, and radically reduced economic activity, which is, of course, the literal definition of stagflation.
Now, when it comes to the inflation that this is causing, as you're famous with saying that energy is everything, energy is life, right? And this then impacts prices of everything, and we're seeing that being exported. Can you expand on the impact the inflation is having right now, and also how it is being exported? How does that work?
The mechanism by which the interconnected world transmits inflationary pulses from one region to another, of course, is through energy. And there's only a finite amount of liquefied natural gas available on the market, for example. So we're working on a piece right now. It'll probably be out by the time this publishes. Tentative title is Last in Line. And we're talking about how some of the early victims of the European energy blunders include countries like Bangladesh and Pakistan. And you might say, oh, well, those are faraway lands. Well, there's 400 million people that live in those two countries, and they have all of the same rights to human dignity that we do in the West. And Bangladesh, for example, just had its entire electricity grid collapse for a period of 7 or 8 hours. They get something like 80% of their electricity from natural gas. Now, fortunately for Bangladesh, they do have a fair amount of long-term contracts with Qatar that secures the sort of foundation of what they need, but they do, top off their demand needs with barges of LNG historically, and they've not purchased any since July because it's just too expensive for them. And also about 6% of their grid is powered by diesel, and that's become much more expensive on the international market as well. So it doesn't take much to short a grid. And Bangladesh, despite having a lot of positive attributes in its economy and a relatively robust currency compared to other emerging markets, is beginning to feel the pinch. Pakistan, much more so. Pakistan, unfortunately, acquires far more of its natural gas on the spot market. And they just held a request for proposal that got no bids for 6 years. They're basically going to have to do without natural gas from the spot market for at least 3 years. And what you would expect is the Pakistani rupee is hyperinflating. Inflation is running wild, and the power grid is experiencing rolling blackouts. This is all because Germany flubbed its energy policy and is now outbidding the rest of the world for the finite number of molecules that are on offer in the global market. And 400 million people in Southeast Asia are going, the first to suffer the consequences of it. And we expect a billion more to follow. You're squeezing a balloon. The air has to show up somewhere. And the early signs of the air showing up in Bangladesh and Pakistan are worrisome signs that we think are early signals of a tough winter ahead, especially if we have a harder than normal winter.
And how do you see this impacting the U.S.? Is there any exported inflation that's coming here, or are the energy shortages also going to be impacting America as well?
America is in a very blessed situation in the sense that it has an abundance of energy along with its NAFTA partners, Mexico and Canada. And we've often said that if you drew a circle around Canada, Mexico, and the United States, you have an energy superpower. You have the CANDU nuclear powerhouse in Canada. You have an abundance of oil, both in the U.S. and Canada and Mexico, and the technological know-how to extract it. We're going to be fine. I mean, the bottom line is we're going to be fine. The fact that we're exporting natural gas via LNG is making natural gas in the United States more expensive historically than it was, but it is still, 1/8 of what natural gas costs in Europe. And so while consumers will feel a bit of a pinch in their winter heating bills compared to our friends in Europe, it will be nothing. And except for perhaps California and the Northeast, which we can talk about separately. And then also very importantly, American manufacturers are set to benefit greatly from the international spread in energy prices as those energy intense industries that are back integrated for all purposes into cheap North American energy, at least relative to the global basis, get to capture that spread. So they make products that are sold on global prices, but they pay regional prices for their inputs. That's a huge advantage for the chemical industry, fertilizers, smelters, pick your favorite energy intense industry. If their products are priced globally and they get back integrate to locally cheap prices, they're going to capture a huge amount of that spread, which we believe ultimately will be part of the closing of the arbitrage as we onshore energy intense industries in Canada, Mexico, and the United States. So by and large, we'll be fine. We have enough energy. We have enough fertilizer. We have ample farmland. We have ample fresh water. We have all the means to sustain ourselves. The big question is politically, as we head into the midterms, will we have export bans on the table that make things worse for the rest of the world, or will we continue to support our allies to the extent that we can? But the crisis is contained. Now, of course, the financial contagion, if, major European banks start failing or, Japanese yen gets out of control and can no longer buy treasuries, like there are financial transfer mechanisms into the economy that we need to be wary of. But molecularly, we're fine.
Now, if we could get to some of those issues that may cause financial contagion there, because we're also seeing, as you mentioned earlier, the escalation of the war. So how could all of that be impacting the financial system in the U.S.?
Yeah, we wrote a piece called The Battle for the Yen recently, where we talked about how the Japanese are in a bit of a pickle. They're major importers of energy. And just today, as we're talking, the line in the sand that the Bank of Japan drew, saying that the currency will be defended at 145. That's been busted through to some extent today. It's trading about 145.50. We'll see if it comes off that. A crisis in Japan will bleed into the U.S. and we believe, and we've obviously got this from many other great analysts like Luke Groman over at Forest for the Trees, that the Fed will be forced to pivot in the face of a Japanese yen crisis, because the Japanese are the largest holders of U.S. treasuries. And if they need to sell those treasuries to support their local currency, which you assume they would do, that would spike yields to unacceptably high levels. So as the yen is weakening today, the U.S. 2-year treasury note, which as our good friend Tony Greer over at TJ Macro calls the bat signal, is yielding 4.31%, which is pretty amazing for short-term paper in the United States. That's up from zero, right? Not that long ago. The 5-year chart of the 2-year note is a pretty remarkable chart to look at. So the transfer function, we believe, might not be Europe as the first flashpoint. It might be the yen. And we're keeping a very close eye on this 145 number, which, as I told you, for the first time since the Bank of Japan intervened a couple of weeks ago, the market is obviously, all pegs fail is sort of the phrase in the currency world. And the Japanese put an unofficial sort of ceiling on the price of the yen, and it busted through today. So we shall see.
What is your expectation of how the volatility of the yen may impact the financial system elsewhere?
I think the direct impact is the forced selling of U.S. treasuries to shore up their local currency. There aren't that many buyers of treasuries left, right? Russia's out. China's been selling. So absent outright monetization, because the U.S., in a slowing economy that Powell is triggering by raising these interest rates, is going to have to fund ever greater deficits as government receipts tank. And so right now, they claim to be raising interest rates and engaging in quantitative tightening as far as the eye can see, but that's unsustainable. I mean, let's just call it what it is. Either interest rates are going to soar to the point where we have a collapse in the financial system, or the Fed's going to have to pivot. And we already saw a potential collapse in the United Kingdom since we last spoke. The pension funds nearly broke when the Bank of England intervened to bring in yields on the government debt back in order. We were hours away from a Lehman-style collapse of the British pension funds, who are much more leveraged than people probably understood, because in their need to go out on the risk curve and chase yield in order to meet their pension obligations, like everybody else, they just levered up directly or indirectly in ways that perhaps might surprise some people. And so we're at a very precarious time. And this is a time for, we're very defensive, of course, and we don't give investment advice, but defensive posture, cash, gold, real assets, food, supplies, preparedness starts at home. That this is our, look, we're Doomberg, so it shouldn't be a surprise to people, but this is our posture today. Much more so than it has been in the past couple of years, to be honest with you.
You mentioned how it's important to even have food supplies. However, I mean, in the US, you mentioned there are enough supplies. Speaking technically, right, there should be enough. But if we do see a shock to the system, a freezing up, that could definitely impact just the way that things flow and everything like that. So can you expand on why, even though there is enough in the US, it may not get to everybody?
Yeah, so we're talking aggregate versus granular. And I personally consider my wife and children as to be the ultimate first stop on my train of things I care about. And just this week, we saw diesel spreads blow out in the Northeast. There's no diesel in the Northeast, basically, is what it comes down to. The November, December front month spread for diesel in the Northeast just blew out, like unbelievable numbers. And what that says, of course, I'm sure many of your listeners have a bit of a preparedness mindset, but most people don't. Most people treat their homes like just-in-time inventory as though they were running a store, and we don't. So we view our home as a factory. Our factory, the main product of our factory is the health and well-being of our family. And the inputs to our home are food and water and goods and services and electricity and natural gas, and the outputs are waste and sewage. And we have a contingency plan for losing all of those things for a certain amount of time. We're not good for years, but we're good for 30 days. And so all we've done is increase the working capital of our home factory, which is simultaneously an insurance policy and a hedge against inflation. And we eat what we store, and we store what we eat, and we rotate. And we have, preparedness starts at home. And we're firm believers that if you can take care of yourselves, then you can help your neighbors. And we do that. And we're very purposeful about it. We're not ashamed to say it. We are unabashed preppers. And we have developed contingency plans, because if you can't, like you say, put on your oxygen mask before assisting others on the plane, it's the same thing at home in our communities. And we are proud to be prepared. And I think everyone should be. The store shelves will go empty pretty quickly. The average inventory at your local grocery store is something like 3 to 4 days. So we have much more inventory at home and are proud to have it.
Now, you also mentioned having a physical gold really to fortify your finances. Your perspective on that, the importance of holding physical metal right now.
Our investing philosophy, I think we discussed it before, but if not, I'll repeat it, is we earn money in fiat. Everybody does. Our walking around money is in fiat. We save money by buying real assets, and gold is a significant part of those real assets. And then we invest privately where we can affect the outcome, with what we call sweat alpha, where you get involved and management, and you can bring your own contacts and skills to bear to help create disproportionate returns on your own. We don't gamble in the stock market because we think it's a rigged game. To your question on gold, we own a fair amount of physical gold and other collectibles. It's a allocation. But that is very important. This is not an investing strategy. This is a saving strategy. So I know that if I have, 20 ounces, 20 American Gold Eagles, that's roughly worth a mid-sized SUV today, right? If I hand 20 American Gold Eagles to my kids in 20 years, I'm giving them the purchasing power of a mid-sized SUV in 20 years. That is the point of my gold. My gold doesn't compound. I don't look at the price of gold. I look at the number of ounces of gold that I have either in my personal possession or, stored in a safety deposit box, or pick your favorite way that you like to store your gold. I also do engage in some paper saving of gold. My preferred vehicle to do that is the Sprott Physical Gold Trust, because I do think that the gold is actually there and they don't participate in the futures market. Many people don't trust the paper market at all, but if I have a slunk of cash and I just want to hold it in gold instead of in low yield bank accounts or investment brokerage accounts, I just put it in FIS and I don't think about it, because I know that I have a chunk of my net worth tied up in something that I believe is durable across generations. But it's very clear that we don't view gold as an investment. We don't try to time the market. Don't even really look at the price of gold. We do try to buy a certain amount every month that we want to save. And so we just sort of have a steady order coming in. I view the amount of gold that I own as participating in constructing a higher floor to the net worth that I can leave my children, if that makes sense. I want to raise that floor every month, every year, every quarter, every year, every decade. And land, collectibles, gold, silver. We like to diversify our real assets across those classes. And then the rest of the money we use for investing and trying to compound our wealth, and like everybody else. But gold is a completely separate category to our investments.
It definitely is a separate category, I think, as insurance, and really that floor for your net worth, I think, is a great way to look at it in that respect. In your perspective, as we're looking into this, what would be the most important things to look at going into the end of the year with the European energy crisis? The currency valuations seem to be going crazy right now with the rising dollar. Your perspective on what are the key things to be looking at right now?
So maybe to bring the conversation full circle, I think, especially if you're interested in the paper price of gold versus the real price of gold, there is a move amongst the countries who are both energy producers and energy users who are feeling that the U.S. is a bit antagonistic towards them. There is a move for them to try to get off the U.S. dollar for clearing energy and to move to a system that involves gold. And if they did that, you could see substantial dislocations in the price of gold. And we're talking Russia, China, India, Brazil, South Africa, and most importantly, Saudi Arabia. And the OPEC production cut this week is really, since they can't really hit their quotas anyway, more of a symbolic slap in the face to the Biden administration. Let's call it what it is a strong sign that Saudi Arabia, the alliance between Saudi Arabia and the U.S. is on shaky ground. So what does this mean? If half of the world, because we're talking about 3 to 4 billion people, decide that they're going to create a currency backed by commodities that they can transact their energy needs in, and they would settle their trade balances in, at least partially, in physical gold, you would be taking the power away from the Western banks, the LBMA, COMEX, for setting the paper price of gold, because the actual price of gold would be set in real transactions on a multi tens of billions of dollars scale in the energy market. And the price of gold would be what those set of countries decided it would be. And it could be much higher than it is today. But if they did, it would represent a very quick arbitrage to drain gold from the West and move it east. And they may want to purposely do that for their own advantages. And so that's the big thing that we are looking at on the horizon. It's sort of, it's poo-pooed in the Western press as gold bug conspiracy theory. But if we learned anything in the past couple of years, a lot of conspiracy theories are turning out to be conspiracy facts, and we shall see. The U.S. is weaponizing the dollar. That's just undeniable. And there's an awful lot of people with an awful lot of power to develop their own responses to that, and we shall see. I think keep a very close eye on whether Saudi Arabia, China, and Russia, and India, etc., make a push for a non-dollar based system for trading energy around the world. So in this scenario, Russia would sell energy to China. China would sell finished goods to Russia. And whatever imbalances occurred would be settled in physical gold. Well, there needs to be a price for that physical gold. And we suspect that that block of half the world probably is not going to trust the LBMA to set that price. So we'll leave it at that.
It definitely does seem like an interesting world is developing out there, especially with respect to the gold market. And yeah, it might be a different, really a different exchange that sets that price. And, who knows what the price would be at that point. But any last thoughts before we let you go? And where can our viewers find you online if they're interested in learning more, Doomberg?
Yeah, no, that's probably a great place to end it. I know the future of gold is of high interest, and so it's a good little tidbit to leave on. We can be found at doomberg.substack.com. I believe since we last spoke, we have crossed to become the #1 financial Substack in the world, which is a really amazing accomplishment for us and something that we're extremely proud of, very grateful for, humbled by the support of our subscribers. We're 100% subscriber supported. And it truly is, it's testimony that if you pour your heart into something and you do so authentically and strive to improve every day, that you can build something out of nothing. We started Doomberg 18 months ago with a keyboard. And it's been a really phenomenal run. We're very proud of it. You can also follow us on Twitter at DoombergT. Add the T there for Twitter at the end of our name. But other than that, Elijah, it was really great. And happy to come back anytime you'll have us.
All right. Thank you so much, Doomberg. And congratulations on that becoming #1 on Substack. We'll include the link to that in the description of this video. So we do encourage all our viewers to check that out. Once again, thank you so much for your time and God bless.
Same to you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.